Welcome back, everyone. Michael here with Offshore Citizen. I was watching a video earlier about different ways of reducing your taxable income. It was very centric to what I would call normal people in a specific country. And so I decided I'm going to do for you a video kind of along the same lines, which is 6 ways to reduce your taxable income, international edition. So we're going to discuss, based on international structures, international options, how it is you might do things differently. And interestingly, none of these 6 things that I'm going to go over actually require that you relocate, which oftentimes people are contacting me to say, hey, listen, where do I relocate? How do I go there? What visas should I get? Et cetera, et cetera. None of these are going to require that, and they're all going to be great ways to reduce your taxable income. So we're going to dive in and discuss that. Before we do that, if you haven't already, please smash the subscribe button, nail the notification bell. Really appreciate your support. If you like the videos, please share them with your friends. Check out our other videos. And if you'd like help with international structuring, either for yourself personally or for your business, in terms of the strategy or the implementation, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or check out our websites, offshorecitizen.net, offshorecapitalist.com, and send us a message through there. All right. So diving right in, just a little bit of background context, there are basically 3 ways you can reduce your taxes. They are, paying a lower tax rate, reducing your taxable income, or deferring. So here we're primarily going to focus not on reducing your tax rate. There's lots of strategies for that, but we're going to focus on reducing your taxable income and or deferring, okay? So the first strategy is one that everybody should be doing, which is you should operate through a business, okay? So this is one of the things that has come up when I'm talking to people with respect to, say, they're traders or something like that. Now, this doesn't work in every country, right? It's country by country, but very often, the business tax rate is down here and the personal tax rate is up here. You can see this in Ireland, you can see this in the UK, you can see this in the US, you can see, across the board, this is very, very common. So being able to operate there, that's going to allow you, or through a business, is going to allow you to potentially defer by paying a lower amount of tax. But that's not the big thing. The big thing is, of course, you can spend pre-tax dollars instead of after-tax dollars. So for instance, your cell phone, your house, well, maybe part of your house, maybe some of your transportation, etc. Now, here's the thing. There's always limitations on that, or not always, but often. If you're in Hong Kong, you can basically buy roses for your wife, and that can become a taxable deduction. But generally speaking, there are limitations. And so, for example, in Canada, if you go and you pay for a meal, typically, it's going to be a 50% write-off, not 100% write-off, okay? Not so great. Now, this is an advantage of operating through an international company, and we're going to cover around some of these other things. So maybe instead of operating through a domestic company, you might operate through an international company. And here's the thing. You can do this potentially even if you're ultimately going to pay tax on the income of that of that international company. Here's an example. If you're talking about the US, okay, say I have a domestic company which owns a foreign company. The foreign company is probably going to be subject to GILTI tax. Now, that GILTI tax, okay, 10.5% at this point in time, more or less, as opposed to, say, 21% domestically, just on the federal level, let alone state tax. So, okay, you're at a reduced tax rate. But the other thing that goes along with it is that's the income attributable to the shareholders, okay? So what does that mean? What that means is that that's after they've calculated out all these expenses. And it's not the same as, say, the restrictions that you have based on the IRS rules domestically for write-offs, okay? So a lot of the things that you may not be able to write off if you're setting up a domestic company, you can when you're operating through an international company. So this is very useful. Now, of course, the opposite could happen if you were to choose the wrong location, but that's potentially a really great option for you, okay? What is the number 2 thing that we can do? The number 2 thing we can do is invest through foreign trusts, okay? So obviously domestically, if you're in a lot of different countries, you have things like, 401ks, you have SEP IRAs, you have, there's a self-employed option for kind of like a retirement plan in UK, there's RRSPs in Canada, there's, various different plans that are kind of tax deferral, and they allow you to reduce your taxable income. Now, in the case of international, which you're typically or often able to do, not in all cases, right? Again, it's country by country, there's some complexities. It's hard to do in Canada, it's easy to do in some other places, is to operate through an international trust. So in other words, think of it this way. A lot of people are going to have some sort of I'm not going to use the term retirement. I'm not a big fan of retirement, but some savings that they're really not going to touch, right? These are like long-term savings. Well, if you're doing that domestically, sometimes you can do it just fine, right? For example, if you're in the US and you're buying real estate, you can do 1031 exchanges. We're talking about ending that, but at least for now, you can do that and just keep rolling the money over. Okay, great. Sometimes, again, you can do it through these various investment vehicles, through something like an RSP in Canada, something like an IRA in the US, etc. But sometimes you exceed the threshold of those, and sometimes there's limitations on it, etc. So the way to do it internationally is to potentially have some sort of a foreign trust structure. Now, in some countries, you might even just be able to use a foreign company, period. But usually, if you're having issues with some sort of CFC rules or something like that, the way around those is foreign trusts. What does this effectively mean for you? It means you could run your investments through there and just compound them over a long period of time without incurring tax. Now, usually when you take it back or get paid out on it, etc., you're going to be subject to tax. But the value of that compounding can be significant. So if you just imagine, okay, I'm just going to keep putting money in there. Now again, it doesn't work in every country. Some countries have different rules about gifting and transfers and things like this. Sometimes what you need to do is you need to set it up first so that the company is, say, held in the trust so that the money actually gets delayed being distributed to you, and you kind of split that out. And this is a strategy that it has a certain amount of cost associated with setting it up and maintaining it, and so it's not necessarily viable when you're talking about smaller amounts of money. But as it gets larger, this could be very interesting. Number 3 thing that you can do is basically the subject of traveling abroad. Okay, so this is something that I think is really interesting. It doesn't necessarily need to be abroad, but out of your hometown. Let's use an example of this. Very often, expenses that would be considered taxable benefits or personal things are not when you're traveling. Okay, so let's use an example. If your employer sends you to a conference somewhere and they pay for your hotel room, they pay for your meals, etc., often this is an expense for them and not income for you, right? If I go on some business trip, well, it's a business expense, right? Likewise, I was mentioning about the example in Canada of where, hey, listen, I go out for a business meal with somebody and I pay for it, it's 50% write-off. But if I'm paying for a meal while I'm traveling, it's just part of the expenses of travel, and that can be written off differently. So there's a lot you can do by taking advantage of being abroad, right? Just being outside of the place that you're actually doing the business. Interesting strategy. 4th thing, employ people abroad. So I've talked lots about how there's just practical reasons from a cost-benefit standpoint of employing people abroad anyway, right? But the other thing that you can do here is you can basically, these all work together, right? And say you have that foreign company. Okay, employ people in that foreign company instead of hiring them in, Wisconsin, hire them in Ukraine. You can probably bill out to them at an arm's length standard. So basically they would work for a foreign company, right? And you can probably bill a domestic company the same amount as you would if you were paying people locally, even though it costs less, and basically transfer profits over there, and then defer those profits or pay a lower amount of tax on those profits, which is pretty favorable. So again, there's transfer pricing rules in this case. You have to pay attention to, is it a fair arm's length standard, et cetera. But you can actually reduce your tax. You're not just reducing your expenses, you're potentially reducing your taxes at the same time, which means you kind of get a double benefit by doing that. Okay, so the next one that we are going to talk about is an interesting one that I don't hear people discuss very often. And this is the subject of turning your hobbies into businesses. Okay, so I think this is one of the kind of least appreciated things, especially if you can do this with friends. So you kind of share a hobby. You can take a bunch of expenses, which would normally be concerns for you, and you can say, oh, hey, you know what, this can suddenly become a business. Now, this business doesn't necessarily have to make money because normally it would cost you money. The difference is now it's a business expense as opposed to before it not being. So let's use some examples of this. Maybe you like cars and you decide to start an exotic car rental company. Maybe you're going to host events and you're going to make these into some sort of promotion, right? So you kind of think about it, you're like, okay, well, owning some certain things might not qualify as an expense in certain environments. But if your business is that promotion or marketing, well then now all of a sudden it can be, right? So lots of ways that you can do this, right? You can make almost anything into a business because you can provide that to other people. And the moment that you do that, I mean, there's just a ton of payoffs that can come about with it. And as I said, to me, the big secret is if you can do that with other people. You can say, hey, listen, let's all do this, right? Let's all throw the money that we'd normally put into this hobby into this business. Maybe the business is actually going to make money, right? Maybe we're going to connect with people. Maybe there's going to be some outfall of that. But at the very least, we're essentially turning something that we'd be paying for anyway into a write-off. So I think that's all of them. Let's see, I'll recap them quickly here. So we've got operate through a company, right? Very important, being able to do that. The last one. So I guess we haven't got to the last one. So yeah, number 2 is invest through a foreign trust. Number 3 is traveling abroad. Number 4 is employing people abroad. Number 5 is turning your business into a hobby. And number 6 is borrowing rather than selling. So this is one of the things that happens very, very frequently. And there's really interesting things. I was just talking to somebody the other day who runs a service where if you have basically any public market stock, they can lend you money against it at very competitive interest rates very quickly and easily, right? So why would you not want to do this in an inflation environment? You know, if you can sit there and here's the interesting thing, okay? Here's the interesting thing about this, is in those situations, they will actually take the risk on the value of the stock. Meaning say the way that it works is, let's say you have stock, right? They go based on the trading volume of the stock, how much money they're willing to lend you, okay? So the trading volume is X, and they say, okay, great, we're willing to lend you up to this. And there's a certain loan to value that they're willing to lend on, right? You put that stock up as collateral, they give you cash at a low rate. Now, again, in a high interest rate environment with dividends, et cetera, you can, first of all, write off that interest, right? So that becomes a deductible expense, but you still get access to the money and you still get access to the capital, which is growing, right? But here's the crazy thing. They will take the risk that if that stock drops a whole bunch and becomes worth less than the amount that you borrowed, they're the ones who will take the loss. So this is one example, right? It's looking at public market stocks. Obviously, it doesn't work for if you're doing venture investing. It doesn't work if you're doing, a variety of different other things. But it certainly works with property. It certainly works with certain other types of assets. And so that's definitely, in this type of environment, something that is fairly sensible to do. So those are your 6 different things. Let me know if you guys have some others to throw in there. And I'm going to look forward to seeing you guys on the next video.